11:10. Okay. So there's your macro time. It took buy side. What's the macro, the lunch macro? It's a retracement inside of the range. From 9:30, it's moved up. Starting at 10 o'clock, if we're going to look for a failure swing, running buy side during the macro time, it needs to show a willingness to want to go lower and start seeking sell side. That would be trailed behind a low here, a low here. It could go there. It could go there. But since it's extremely strong, very strong type movement higher, the likelihood of it seeing coming all the way back down to this low, that would mean something if it went through all this consolidation. So it would take a lot to get through that. Here, we have this low, and we have a buy side imbalance, sell side inefficiency. So inside this buy side imbalance, sell side inefficiency, to the left of that, what do we have? That wick. So I'm going to take these vertical lines off. Just know that this portion of price action is what we're aiming to focus in on. But this wick and this gap. So if there's a buy side imbalance, sell side inefficiency, it's the gap that takes precedence. So if the gap's low as here, at this candlestick's open, that's about as low as it could reasonably reach for if it was going to do it. Worst case scenario. Ideally, you want to see it trade to or just above consequent encroachment. To that midpoint, to the candlestick's high or the wick high, that's your sensitive price point. So while we do have that gap here from this candlestick's high and this candlestick's low, this candle right there is your buy side imbalance, sell side inefficiency. Sell side would rest right below that low and reaching into that midpoint level of this wick. Okay. So that's the target. So that was my maximum objective for the macro. And then I was looking for a portion of the trade here. Buy side taken here. And while price was utilizing this buy side imbalance, sell side inefficiency, as I've been teaching, very easy, high probability inversion fair value gaps. The easiest ones I have, the ones that just are just so obvious that you're never going to really miss it. That's what you want in your trading. You want something that's high caliber, that's very specific, it's very precise. You want it to be there in an obvious manner. So if someone was to ask you, where's the obvious fair value gap that you could anticipate trading? Well, it's the first one that forms. But now I've taught you a higher tier understanding where it may not be the actual fair value gap if there's a wick to the left of it. That range is going to be more specific. And you'll use, when it's bearish, you'll use the lower half of the wick. Low of the wick up to consequent encroachment. That'll be your actual first presentation for a fair value gap because we're treating the wick as a gap. Well, when I was teaching the aspects of inversion fair value gap, obviously everybody went ham and started thinking every fair value gap can become an inversion fair value gap. And that's not true. Okay. So when we have a high and we anticipate first by time, macro time between these two vertical lines. Okay. So I'm going to take those lines off. Now we've accomplished the method there. So we know inside that range of time, it can form. What specifically? The lunch macro. What is its default? It runs to sell side. It's defined by time, going back to 10 o'clock. So from 10 o'clock, from where we create the potential setup or the origin of it, the inception of the move going lower, start looking back for the lows, this one and this one. Okay. So because it's a very strong market, that's why I lent my focus only to this. If it would have been part of a bearish market condition, then obviously I would have looked for much lower. I would have looked for the lowest low that formed right after 10 o'clock. Okay. So that's the process and protocol I follow. When we're in a bullish move or a bullish buy program, when the market's likely to continue going higher, I'm only looking for one or two short-term lows that have been trailed up for anyone that's long. So they would have moved their stop loss up here from earlier in the session. And as the market went higher and created this low and started to trade higher, the stop losses would have been moved from here and migrated to below this low here. Okay. So now when price took that buy side here and ran above it, I'm actually looking to go short there. I'm going in there with the intentions that this is probably going to be a intermediate term high intraday, and it's likely to then run for the macro. Now, I want you to think about what I just said. It sounds like a whole bunch of gobbledygook for someone that's brand new. Okay, it sounds like word salad. But for the folks that's been here for a while, you've heard me talk and teach and showcase and actually do these things now. And again, showing you with a live execution. The market goes above this buy side here, runs above it, turtle soup. So we had the higher high here, and then look at where it pulls back. Did this drop down to take out that low? No. So this isn't enough of a criteria. But now when it ran back up, to take that high out, then yes, we went to premium. Premium pulled back, and it didn't validate by having this run here, because it could have came down, hit that, went up, and then maybe set the stage for a lower low, as I was indicating, that lower low right after 10 o'clock. I would have aimed for that one then, if it would have did what I'm explaining here. But because it didn't do that, I wanted to see price run up in here, overtake this sell side imbalance, buy side inefficiency. I wanted to see it overtake that entirely and take out that high. And that run above there, that is not in Street Smart's book. The idea of that open price, when it tried to go up there, when we trade back down through it, that activates this candlestick as a order block, a bearish order block. So it's the full range, but that price, when it trades up into it here, we can utilize that, and that could be an entry mechanism. It could be a pyramiding point. And then the market drops aggressively and takes out the first target there. And then accelerates through that and takes out the sell side there and trades right into consequent encouragement of that wick right there. Now, when price dove through here, it was given two perfect scenarios or signatures that are algorithmic. We first have to cancel the approach of interpreting this as a bullish fair value gap. If this model is, as I'm outlining here, if it's true and everything is on point, the drop down into this candle upper portion here, it needs to give up the ghost. It needs to go through it. It should not go down and start rallying up. Okay? Notice it's not doing that. We go into it, we wick here, give it another chance, another candle, opens, trades up a little bit, trades in the volume of bounce that I don't have annotated there. It drops inside the upper portion of that gap, and then the next one, we open up, touch the high of it, and one little tick outside of it, and then crushes real sharp. And then we go into then looking at how it needs to use premium sensitivity, which is when we're looking for something bearish, it needs to stay out of the upper half and only use the lower half. And then it accelerates to the downside. So again, no market replay up here, okay? No market replay. As price was running up into it, I was trying to hit it as it was getting that. A little bit of heat on it. The next one here, same thing. Trying to key off of when we're close to that price level there. Using market orders, not limit orders. I could have done better with the entries on limiting, but I didn't have any concern about getting all that perfect about it. I just wanted to make sure I got in it. And then here, same thing. We're trading up into the inversion fair value gap in the lower half, part of the bearish order block there. So I went short 10 more, and these are micros. So right now that would be the equivalent of 2 minis, which isn't all that significant. And then adding 10 more here, which is now is the equivalent to 3 minis. Okay. And then once we went below this low here, watch right here. You'll see what the exit is there for 10 of them. And in the final 10, right there at that low,